It's Monday, July 27th. I'm your host, Jason Moser, and on this week's financial show, we're going to dig into Warren Buffett's Bank of America crush. We've got a couple of earnings reports to get to with American Express and Ameris Bancorp. We've got a couple of stocks that we're watching this coming week. Joining me, as always, it's the certified financial planner. He's a year older, he's a year wiser. It's Mr. Matt Frankel. Matt, how's everything going?
Oh, not too bad from your friend down here who's still in his late 30s.
Yeah. It's a nice
how's
luxury
everything
to
in
have.
Virginia?
Everything's good. Everything's good. We're, just keeping busy. I mean, it does seem like, it does seem like life is getting back to normal somewhat. I mean, people wearing masks and being a little bit more thoughtful of space and whatnot, but you can go do a lot of stuff. It seems like people up here are generally doing okay. School is going to be starting out virtually for at least the fall semester, but maybe that's the right decision. I don't know. I guess we'll figure it out when we get there. But everybody's at least healthy and happy. How about y'all?
Yeah, same here. I mean, our daycare. We actually never lost daycare, which we're a big rarity. My kids go to a daycare that's run by the hospital that my wife works at, so they were never even able to close.
Nice.
So the school thing, fortunately for us, is not really an issue to worry about. But I know here they're giving parents an option of in person or online.
Yeah, they did. They actually, Fairfax County in Virginia here is a very, very large county, and they let all of us vote. They let parents vote. Would you want to do like an abbreviated being at school a couple of days a week, or just do all virtual? And it, with close to 200,000 respondents, it came down. It was 60% voted for at least some physical time at school. 40% voted for just nothing but virtual. And when I saw those results, I thought, you know what? I think that's probably a little bit tighter than they were hoping it would be. I think they were hoping for like a 75% one way or the other. So they actually went, a little bit against that decision, and they decided to start things off virtually at least, and figuring that, you can slowly work our way back into it if the conditions improve. So, we'll see. We'll see. They're, interesting times, to say the least. Interesting times for Berkshire Hathaway, too, Matt. Big headline last week, and you even wrote an article about this. Warren Buffett, the title of the article, Warren Buffett just spent another $800 million on this bank stock. Tell us what bank stock and why. What's going on here, Matt?
Well, as a journalist, we, want the headline to draw readers in, but $800 million actually isn't that big for Berkshire standards in the context of this bank stock. It is Bank of America. Bank of America, ticker symbol is BAC for anyone watching at home, is Warren Buffett and Berkshire Hathaway's largest bank stock holding by a large margin, especially now. So what Buffett did, they bought about 34 million shares for an average price of just under $24 a share. They did this last week, so that if you do the math, that works out to about $800 million they invested. This brought their stake in Bank of America up to 11.3% of the bank. To be clear, the only reason we know about this is because they're over that crucial 10% threshold. For example, if Buffett bought more of, say, Goldman Sachs right now, we wouldn't know.
So over 10%, they have to announce that. Like, that's a regulatory filing that has to be.
It's a regulatory thing that they have to, let us know right away, and so that's why we know about it. But anyway, the effect of it was it brought the stake up to 11.3%. It was over 10% already, so this wasn't a giant jump in ownership. But it does show that they're putting money to work and that they still believe very much in Bank of America. That's a big stake. It's worth about $24 billion right now. It's their second largest investment of any kind, a distant second, I should say. The Apple investment is just huge.
Right.
But other than Apple, Bank of America's Berkshire Hathaway's largest stock position, and so an investment that big, I would have to believe that Buffett himself is behind it, not one of the other stock pickers.
Yeah, you'd figure, and I guess that was going to be one of my questions, given that this is such a large holding for him. And I mean, he's got this portfolio of a lot of companies that he's held in there for a long period of time, and Coca-Cola, American Express, Wells Fargo, and I mean, Wells Fargo obviously has been plagued with its problems here, but you look at Bank of America and how these banks have come out of this earnings season. Certainly, Bank of America strikes me as one that is not only doing well, but the market, I think, is giving it a little bit of credit there. I mean, it's a stock that is trading, nicely above its tangible book value in an environment where you're seeing a lot of banks right now that are not necessarily witnessing that same good fortune.
Sure. Well, I mean, one, it's still important to mention that it's way off the highs of the year.
Right.
I mean, most banks are. Not only is the low interest rate environment really not conducive to profitability in banks, but I mean, banks, including Bank of America, all the big banks are setting aside billions of dollars in anticipation of loan losses. The enhanced unemployment benefit just ran out, and unemployment's still in the double digits in America. So that the combination of that could make a tough second half of the year for banks. But at the same time, that mindset is driving the stocks down and creating long-term value for patient investors, which Buffett certainly is one of them.
Oh yeah. And I mean, and we'll talk about this a little bit more when we get into Ameris's most recent quarter. But it's also, we won't neglect the possibilities and likelihoods of consolidation out there. I mean, there will be some more acquisitions here. But you have to figure that some of these banks that are out there trading at below tangible book value, you start looking like some attractive investments out there, and certainly Ameris made mention of that on their call. Yeah, so I mean, like when you look at Berkshire Hathaway going forward, I mean, we've talked a lot about this over the last several years. It's just always seemed kind of odd that Buffett has been so clearly okay with Wells Fargo to date and what Wells Fargo has been doing, even though it doesn't really feel like Wells Fargo has been doing a very good job. I mean, do you feel like, I mean, it seems like maybe Bank of America is taking over that position as maybe the bank that Berkshire Hathaway wants to be best known, in cahoots with, so to speak.
Yeah, but I mean, it's still worth mentioning that Berkshire, combined with Warren Buffett personally, because he owns some Wells Fargo in his personal stock portfolio, owns just under 10% of Wells Fargo. So that's it. I wouldn't completely say that Buffett's lost faith in Wells Fargo, but it definitely seems that Bank of America has become his favorite bank stock. It's worth mentioning that I said earlier that the reason we know that he just bought a lot of Bank of America is because of the 10% thing. So if you look at some of the other bank stocks in Berkshire's portfolio, the stakes are a lot less than 10%. Like, for example, Berkshire owns 1.9% of JP Morgan Chase, 2.2% of PNC Bank. So this isn't to say that Bank of America is the only bank stock that Buffett's buying. And in the past, when he's been buying one, he's been buying the other ones as well. Mm-hmm. A few quarters ago, I think he bought something like 10 different bank stocks. So I wouldn't be surprised at all to see that he spent a lot of money to increase the JP Morgan stake, increase the PNC stake. Maybe he bought some more Wells Fargo because he had sold some. Now it's cheaper. Maybe he bought a little more. I wouldn't be shocked. So I wouldn't be surprised to see that Berkshire's finally starting to deploy some capital. If you remember last quarter, investors were kind of disappointed when we got the earnings results that Berkshire was a net seller of stocks during the first quarter.
Yep.
And it kind of makes sense if you think about Buffett's mentality. At the end of the third, I mean, for the most part, January and February were pretty normal months in terms of the economy and the stock market. I mean, the all-time highs were reached in February.
Right.
So March was really the big opportunity, I guess, quote unquote, when we saw the market kind of plunge. But at the end of the first quarter, at the end of March, it was still pretty chaotic. Mm-hmm. The CARES Act hadn't been passed yet, or hadn't been signed into law yet, or totally implemented yet. I can't remember which. But the stimulus checks didn't start going out till April. So we really didn't have clarity as to where the economy was going and how bad the pandemic was going to get by the end of the first quarter. Buffett hates investing into panics.
Yeah.
He likes investing after the panic has already kind of happened and the market's down. I mean, we're talking about Bank of America. That's considered one of his best financial crisis era investments.
Yeah.
That wasn't made till 2011.
Yep.
So, I mean, he didn't invest in Bank of America during the '08 panic when he could have got it even cheaper. He waited till the dust settled. He found a good value and he invested. So maybe that's what's happening now. And Buffett's finally just kind of, now that things have kind of stabilized, I guess you'd say, especially compared to March.
Yeah.
We're seeing Buffett put a little bit more money in.
One more thing before we move on to American Express, and just wondering your opinion on this, given the status of Bank of America and Berkshire's world today. How much do you think that is due to Brian Moynihan? I mean, as the CEO of Bank of America, he's been there for a while now. Clearly knows what he's doing. Wells Fargo, it's the other side of the coin, right? Just managerial crisis, and hopefully Mr. Sharf is able to get that under control there. But clearly, it seems like Buffett's making his choice here.
I mean, there's no argument you could make where Moynihan's done a bad job at Bank of America. I mean, I'd rank him in the top two big bank CEOs, Jamie Dimon being, those could go either way.
Yeah.
But given what Moynihan was dealt, the hand he was dealt after the financial crisis,
yeah,
the improvement in Bank of America in terms of efficiency, in terms of asset quality, in terms of getting rid of non-core assets, has just been incredible. I mean, before the pandemic started, Bank of America's profit numbers were something you would have considered crazy a few years ago. Like if I had told you they would be producing a double-digit return on equity, if I had told you that right after the financial crisis, you would have told me I was nuts. And they had been doing it for several years before the pandemic started because of Brian Moynihan's just focus on efficiency and closing underperforming branches and embracing technology. Bank of America has won a ton of technology awards for. We talk about Square and PayPal and fintechs like that. Bank of America's technology is the recognition they've gotten for their technology has been just on par with any of the fintechs, and a lot of people don't realize that. So that's been a big part of their efficiency. So they've done a great job of just all around.
Yeah, it really does feel like that. I mean, yeah, you make a great point there. He was dealt a really, really difficult situation. So, I mean, if anything, maybe for Wells Fargo shareholders, Bank of America is proof that it can be done. I mean, we were giving Bank of America a hard time several years ago. So to see that, those turntables have turned, as Michael Scott might say. You never know. Maybe there will be better days ahead for Wells Fargo. Let's take a look at another one of your favorite companies out there. I know you like this company a lot. We've talked about it before as being, potentially an addition to a war on cash part. But right now, it's still on the outside looking in. American Express earnings, not the greatest year so far for the company. Certainly understandable. I mean, it is a bank after all, too. But what stood out to you in the quarter?
Well, first, let me just go over kind of the gloom and doom numbers of the situation. Profits were down 85% year over year, which, I mean, I was actually impressed they were still profitable. A lot of banks weren't.
Yeah.
Revenue dropped 29%. People just weren't, I mean, American Express's slogan, never leave home without it. Well, people couldn't leave home at all, so they couldn't really do a whole lot with their credit cards.
It's a very good point.
When you think about it, I mean, do you have an American Express card, Jason?
I do. I am a proud card member, I guess they would say, for, I don't know, probably 15 years now or something.
So you understand that most of their perks are travel oriented.
Yes, I do.
And no one was traveling in the first half of this year for the most part.
No, we were not.
But American Express, what stood out to me, and this isn't really part of the earnings report. I'll get to more of the gloom and doom numbers in a second. But American Express really, to me, just did a great job pivoting. When you think of, a lot of credit card companies gave people, an extra % back in rewards on groceries or something like that for the pandemic. American Express really pivoted their benefits entirely. My American Express card, I now get a $20 statement credit for having my streaming services billed to the card.
Nice.
A $20 monthly statement credit for having my mobile phone bill billed to the card.
Wow.
And that's on top of the other benefits and the rationale with that is because I wasn't able to use my travel benefits. So they gave me something. My business Amex, I have the business version of the Delta card. Gave everybody a $75 loyalty credit, just a statement credit for $75 out of the blue.
Nice.
So they're doing a great job of customer retention. I have to believe that a lot of people canceled credit cards during the pandemic, especially ones with annual fees.
Yeah.
If you can't go out and use the benefits, what's the point of paying a fee for it? So they did a great job. I think you're going to see great consumer retention numbers. But year over year, their credit card balances are down 36% at the end of the second quarter. That's a pretty big drop. And that's balances. That's not just activity.
Yeah.
And because you remember, American Express is at its heart primarily a charge card company, not a carry a balance credit card. The Amex Platinum is a charge card. You pay your balance every month for the most part. There are some pay as you go options, but so that's really hit them in terms of outstanding balances and things like that. American Express built their loss reserves by almost $630 million.
Wow.
During the quarter. But when you look a little deeper, that assumes that loss build or the reserve build is assuming about a 10% unemployment rate at the end of this year.
Yeah.
Which I think might be a little of a stretch. It's assuming a 1.7% GDP drop in the fourth quarter of this year.
Yeah, I don't know.
Which most experts are expecting the economy to rebound, especially by the fourth quarter, if not in the third. So the point is that's a loss reserve. That's not based on actual losses that they've had. And that's reflected in their profitability numbers. So and we saw this at the end of the financial crisis, some banks overestimated their losses and eventually they release those reserves and they get counted back as earnings in the end. So this isn't necessarily lost money. We still have to see how this plays out. The banks including Amex, are being cautious. Like I said, they've done a great job of cutting costs. The stock's still down over 20% year to date. I've been a shareholder of Amex since before I was a cardholder of Amex. It was one of the first stocks I bought, and I still hold it, and I think it's a good value. And I think the company is one of the most overlooked fintechs.
I tend to agree with you on it does seem like it's overlooked in the sense that people think it's just sort of an old school type of company in some ways, but it absolutely has one of the strongest brands out there that I can really think of. And I don't know, maybe it's not their secret sauce, but it's certainly something that really separates them is their focus on the customer experience and customer service is really, really strong. I mean, it is one of those things that's a noticeable difference. They just have a different level, it seems like, of customer service. And maybe that is something that keeps people with them, even if they're not spending. I mean, those credits, whatever it may be, or waiving an annual fee, or whatever it may be, they just have a knack for doing that kind of stuff. And that does resonate with consumers in tough times like these, for sure.
Yeah, like I said, they've just been and they were focusing on the millennial group. That's kind of the streaming credit is, I think that's kind of to replace the Uber credit. If you remember, Amex rolled that out. People can't use the Uber credit for the most part right now. I actually used mine this month.
Oh, really?
Yeah, I was up your way in Maryland, and I actually used my Uber credit for the first time this year. Was that when you were out there gambling with Dan Klein? I was not. Dan Klein was nowhere to be found. My wife has a sister that's 20 years younger and just got her driver's license, and we helped her get a car, and I had to drive it up there. She lives up that way. Man, so man. I was up there, and then I had to Uber back to the airport, so I got to use my Uber credit. But anyway, the streaming credit was really to replace that for millennials, and they're doing a great job of just kind of thinking outside the box. Like I said, a lot of other credit card issuers are boosting their grocery reward rate from 2% to 3% or something like that. But a benefit like, okay, get a streaming service, it's on us. That's something that's really outside the box that I think that really resonates with the younger generation, especially, who doesn't really think in terms of cash back. They want perks. That's what you're paying for. I'm not paying $500 a year for my Platinum card for the cash back rate. I'm paying for the benefits that come with it that I'm currently not able to use. So they're really doing a great job of still creating a value proposition for their credit cards, and I think that's really going to pay dividends over this year.
Good deal. Good deal. Well, this morning, Ameris Bancorp also released their second quarter earnings report, and Ameris, that just small little Georgia bank, right? It was based out of Moultrie. I think they're based out of Atlanta now, with the Fidelity acquisition being all taken care of. But a small cap bank that has done, I think, a really good job, particularly in a very difficult time. I mean, we've talked a lot about the challenges with bigger banks in this interest rate environment. Frankly, smaller banks, I think it's an even steeper uphill climb because they're smaller and they don't have necessarily the same resources. But when you look at Ameris, what they continue to do, total assets up just a skosh under $20 billion now. Total deposits of $15.6 billion. That was up from $14 billion at the end of 2019. It's important to note, and we talk about this every quarter because it really matters, particularly these days. Net interest margin actually expanded for Ameris for the quarter. Yeah, it's like 13 basis points. I mean, I think expanding anything in this environment is probably worth writing home to. But I think it's important for them to note that part of the Fidelity acquisition, part of their philosophy is trying to make sure that non-interest bearing deposits, continue to be a substantial portion of their deposit base, right? That brings the expenses on those deposits down, right? That the non-interest bearing deposits made up 36% of total deposits this quarter. That's down from 30%. That's up 30% from a year ago. So, that is a way to really help combat the difficult interest rate environment where you're not really making much on the money that you're lending out.
Yeah, you'll really see that come into play when interest rates start to rise again.
Yeah.
Because right. If they're still they're essentially borrowing money at 0% if in a non-interest bearing deposit. And then as the amount they can make from loans goes up and up and up, the spread will the non-interest bearing deposits really make a great profit spread.
Oh yeah, absolutely. And we talked about it with American Express and with all of the other banks. We talking about these credit losses, these reserves that banks are putting forth to try to deal with this. Ameris they've had a lot of the Paycheck Protection Plan lending going on. That has its puts and takes. It's not like it's some big profitable endeavor, but they're being a part of the solution, right? And that really is something where, if you're a bank that's being seen as a part of the solution, you typically can emerge from a situation like this being a little bit stronger. But when you look at the reserves that they're putting aside for potential losses, they recorded another $88.2 million this quarter compared to $41 million just in the first quarter. So if all in total, if you look at $130 million or so that they've put aside so far, that's about 0.65% of their total assets. Now, the only reason I'm bringing this up is because I thought it would be interesting to take a look at a big bank and say, okay, well, what kind of percentage of those total assets does it look like for Wells Fargo? They total about $20 billion right now in reserves for the year. And that's about 1% of their total assets. So, Wells Fargo, obviously a big bank, tremendous balance sheet, lots of assets. But, that's a company that's had a little bit of a tough time here and some self-inflicted injuries. And they've had to reserve a good bit more. So it seems like, Ameris' ratios, efficiency, all that stuff, they continue to run a tight ship. And that, for me, I think is really, really encouraging for shareholders. The thing that stood out to me, though, Matt, in the call, and they just got done with this Fidelity acquisition. That was about $750 million acquisition. But given the conditions in the banking space today, some of the valuations that are out there, it could be argued there probably are some opportunities. And the questions of mergers and acquisitions were brought up on the call. And it sounds really like the Ameris team is ready to get back to it. And they are looking, generally speaking, in that same geographical area. But I was really impressed with the target. They were saying that they can expect a deal from anywhere of $2.5 billion in up, which, really, the Fidelity, that was a big deal for them. So you're talking about with something they're targeting now being considerably larger than that deal. I mean, while a bank's kind of trying to bide its time here in this is low interest rate environment, we forget sometimes they can grow via acquisition. It sounds like that might be, on the horizon here for Ameris, and they have a good track record of doing good deals to this point. So I don't know, cautiously optimistic, I guess.
Yeah, I mean, I thought Ameris's quarter was pretty impressive. Their mortgage business especially was one that really stood out to me.
Yeah.
Mortgage business up $70 million quarter over quarter. People are really taking advantage of the low mortgage rates, and
got to.
For a small bank, that's an impressive number.
It is, yeah, and it sounds like they may be getting bigger sooner or later. So, we'll continue to keep an eye on it, and continue to cover it here on the show. Okay, Matt, before we wrap it up this week, let's jump into earnings season here and give our listeners a stock that we'll be watching this coming week. What is a stock that you'll be watching?
I am watching Markel. That's one that I mention a lot. That's the position I've added the most to during the pandemic. So I'll tell you that much. I'm watching their insurance profitability. We mentioned before on the show that we really don't know what the pandemic is going to do to insurers in general. Markel was unprofitable insurance-wise last quarter. Their investment portfolio didn't do particularly well, so I'm keeping an eye on Markel's earnings. The stock's run up pretty good lately. I'm watching for signs that valuation is justified, and I'm crossing my fingers and hoping that it is. So,
yeah.
What are you watching?
One I own too, and I like it a lot. I'll keep an eye on that one, but I'm going to watch out for another one that I own, Mastercard. Ticker is MA. Earnings are out on Thursday for Mastercard this week. Busy week, and Thursday is the day for Mastercard. Really, I'm just kind of, based on what we were talking about with American Express and all these banks, I'm interested to see how the big dogs in the payment space are really handling what's going on, because Mastercard and Visa, we talk about it all the time, not banks, right? They're not lending the money. A little bit of a different business model there, so their exposure is certainly tied more directly to consumer spending, but it's really attractive high margin business models. I'll just be interested to see what they're seeing, what their experience has been these last several months, and kind of see if they have any ideas of how the rest of the year is shaking out. But another one that we like here, and one that I own and will continue to own, because hey, Matt, that war on cash, it's real, man.
For sure.
That's going to do it for us this week, folks. Remember, you can always reach out to us on Twitter at MF Industry Focus. You can drop us an email at industryfocus@fool.com. We always love hearing from you. Matt, I appreciate you taking the time out of your schedule this week to join us, as always. Glad to hear you had a nice birthday, and hey, let's make this the best year yet. How about that?
I hope so. Well, as soon as 2020 is over, it's going to get better. I think 2021 might be my best year yet. I don't want to call 2020 my best year yet.
Well, we'll just continue to check in week by week and see how things are going.
That's not setting the bar very high.
All right, man. Well, we'll look forward to catching you next week.
All righty.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. A big thanks to Tim Sparks for making all of this happen for us each and every week. For Matt Frankel, I'm Jason Moser. Thanks for listening, and we'll see you next week.